Hi, this is Indraneel and you are watching Business Bytes in our channel The Spotlight, India's first online business news channel. In today's Business Bytes, first news we have, after an unsuccessful joint venture discussion with Mahindra & Mahindra, Volkswagen India has revived their discussion with JSW Group for a potential joint venture. Second news we have, India's leading maternity and pediatric care chain Cloud9 Hospitals to acquire Apollo Cradle and Children Hospital at 1,500 crore. Third news we have, packaged food and staple maker LT Foods to acquire 100% stake in Hungary-based company Global Green. Fourth news we have, subsidiary of Tata Power Nelco to focus on government sector and enterprises with next generation SATCOM services. And fifth news we have, the Indian Premier League, that is IPL tournament's valuation has declined for the second consecutive year to 76,100 crore. In first news, after an unsuccessful joint venture discussion with Mahindra & Mahindra, Volkswagen India has revived their discussion with JSW Group for a potential joint venture. Volkswagen Group is home to brands like Skoda, Audi, Porsche and Bentley, while Volkswagen Group's India strategy is led by Skoda. Under the proposed terms, JSW would lead the local operations in India through mobility arm JSW Auto while leveraging technology and product platforms from both Volkswagen and SAIC Motor, which is the Chinese parent of MG Motor India, with which the JSW Group is already having their alliance. To fully explore India's growth potential, Volkswagen Group always considering new business opportunities and are evaluating various options to ensure the best possible solution to implement their strategy in the highly dynamic Indian market. With a successful move towards the JV, Volkswagen Group would mark a significant step forward in the world's third largest auto market, where it has been a marginal player despite a presence that stretches over 2 decades. Volkswagen and SAIC already share a 50-50 joint venture in China, which is one of the most successful automotive collaborations in that market for over 2 decades. This existing relationship provides a natural foundation for a similar partnership in India. Volkswagen Group has been actively seeking a local partner amid the Indian government's push for electric vehicles and stricter carbon emission norms, which require substantial investment in new technologies and localization. In second news, India's leading maternity and pediatric care chain Cloud9 Hospitals to acquire Apollo Cradle and Children Hospital at 1,500 crore. Apollo Cradle is a unit of Apollo Specialty Hospitals and runs a network of maternity and infant care centers across India. Their operations span about 363 beds across 13 hospitals in key markets like Bangalore, Chennai, Amritsar, Uttar Pradesh, Delhi NCR, Gurugram and Hyderabad, while according to their annual report, in the last fiscal year, the company incurred a 40 lakh net loss. On the other side, Bangalore-based Cloud9 Hospitals was founded in 2006 by neonatologist R. Kishore Kumar along with co-founders Rohit M.A., M. Ramachandra and Vidya Kumar. The chain of hospital operated under Kids Clinic India, Cloud9, and having 40 centers as of March 2025 in major Indian cities. The company added 7 new centers in financial year 2025 and plans to add another 6 to 7 hospitals this fiscal. The chain's specialties span maternity care, gynecology, pediatrics, neonatology, fertility and stem cell banking. And with this fresh deal with Apollo Cradle, Cloud9 will be the largest integrated maternity and pediatric care network in the country, significantly expanding its geographic footprint and competitive strength in the segment. Private equity firm True North, TPG Newquest and Temasek together hold around 77% stake in Cloud9, while the promoter group owns about 10%, with the balance held through employee stock options. In financial year 2025, Cloud9 recorded total revenue of 1,486 crore, which is a 25% year-on-year revenue growth, and that's supported by their expanding hospital network and contributions from recently launched centers. However, its operating margin moderates to 13% from 14.7% in financial year 2024 due to initial operating losses from centers opened in the last 2 fiscal years. In third news, packaged foods and staple maker LT Foods to acquire 100% stake in Hungary-based company Global Green Europe KFT for 25 million euros via its European subsidiary. The Hungarian operations of Global Green were established in 2006 following the acquisition of the erstwhile Intergarden NV, with operations now in more than 30 countries across Europe. The European firm makes and sells sweet corn gherkins, silver skin onions, peas and sour cherries in jars and cans, and has two manufacturing sites. It has an annual turnover of 40 million euros and a workforce of over 170 employees. The acquisition will be executed through LT Food Europe Holdings, a wholly owned step-down subsidiary of LT Foods, and the deal includes two support entities, and the acquisition will help LT Foods to diversify into a large addressable market, where LT Foods will pay 6 million euros at closing for 100% equity shareholding, with the remaining 1.8 million euros payable over the next 2 years through an earn-out mechanism besides taking over the borrowings. The transaction includes the acquisition of Global Green International UK and Greenhouse Agrar KFT, which are its support and distribution entities. In fourth news, subsidiary of Tata Power Nelco to focus on government sector and enterprises with next generation SATCOM service. Nelco to expect a breakout curve in SATCOM adoption, particularly in the B2B, that is business to business, and B2G, that is business to government sector, as the convergence of satellite broadband and terrestrial 4G technologies could enable new use cases where the economics of SATCOM services for a price sensitive market like India would be difficult to adjust for the retail consumer category. In India, while fiber broadband is priced at a modest monthly outlay of 500 to 800, a satellite communication service requires an upfront investment for the terminal, which even at materially subsidized price point of around 10,000 to 15,000 remains prohibitively expensive for home broadband apart from the higher monthly charges. However, enterprises see value in making necessary investment for SATCOM services for ensuring last-mile connectivity to remote facilities like bank branches or schools, etc., where the VSAT license holder is already a managed services provider for commercial SATCOM usage, including powering ATMs, connecting remote bank branches, enabling telecom backhaul, supporting defense networks, and connecting offshore oil rigs and vessels. The company Nelco is expecting a significant growth in the Indian B2B and B2G SATCOM services market by 2030, initially led by the core sectors such as telecom backhaul, government welfare programs, defense networks deployments, energy and utilities, where the next wave of SATCOM services will be defined by integration with emerging technologies, unlocking use cases like precision agriculture, autonomous operations in mining and logistics, assets tracking, and many other Internet of Remote Things applications. And in fifth news, the Indian Premier League, that is IPL tournament's valuation has declined for the second consecutive year to 76,100 crore, that is 8.8 billion in 2025, from 82,700 crore, that is 9.9 billion in 2024, and 92,500 crore, that is 11.2 billion in 2023. According to a valuation report, the reduction of 16,400 crore over the last 2 years reflects a fundamental reset in India's cricket economy, a combination of media consolidation and the government's ban on real money gaming, that is RMG sponsorships, which have given a substantial negative impact over the tournament. On that context, majorly two structural shifts identified behind the value reduction. The first was the merger of Disney Star and Viacom18 and JioStar, which unified television and digital rights under one umbrella. The consolidation effectively ended the intense bidding war that previously inflated media rights valuation. The second disruptive factor is the government's prohibition of the RMG, that is real money gaming advertising and sponsorship, which has wiped out an estimated 1,500 to 2,000 crore of annual spending from the IPL ecosystem alone. The last major right sales in 2022 had set a new benchmark as the Board of Control for Cricket in India, that is BCCI, sold IPL media rights for 48,390 crore for the period of 2023 to 27 cycle, where Disney Star retained the television rights while Viacom 18's Jio Cinema won digital streaming. The deal was a threefold jump over the 16,347 crore Star India paid for 2018 to 22 period and almost 6 times Sony Pictures Networks India's 8,200 crore outlay for the period of 2009 to 2017. So these were the top 5 business news from Business Bytes in our channel The Spotlight, India's first online business news channel. I would like to request you to please subscribe this channel so that you can have all the updates from our end. Thank you very much for watching Business Bytes and signing it off.